My name is Alex von Schlegel. I'm going to be presenting on the liabilities and the stockholders' equity portion of the forecasted financial statements that my group made, and we're in the group 6. So for our project, we decided to choose a small little golf course up in Northern California called Del Norte Golf Course, and it's located in Crescent City, California. It's a relatively small golf course. There's 18 holes, and it costs about $4 for a large bucket if you want to just do the driving range. But overall, it's pretty cheap to go golfing there. And we were able to find it that it's actually available. It's listed for sale, and we found the selling price that it's trying to be sold at is $900,000. So I'm going to go ahead and go through the liabilities portion of the balance sheet first. So I'm going to start with our accounts payable. So how we did that, we had the days of accounts payable that we calculated in our assumptions, and then we took the cost of goods sold and divided that by 365 to get the total amount of days, and we should get the total amount of expense and times by the days of accounts payable. And the next liability we have under current liabilities is the income tax payable that we have to pay for the income taxes that we accrued from the previous year. And we just drag that down from our income statement for our income tax expense. So that's our total current liabilities, and that comes out to about $68,000. And next we have our mortgage loan, which is considered a long-term liability, and that comes out to $911,454. And how we found that is we were able to find the selling price of the company that they're trying to sell it for, which was $900,000, and we decided we're going to do a 30% down payment. And then we were able to find the average interest rate for a 30-year fixed mortgage, and we averaged it out to about 3.5%. And that's a 30-year mortgage, so we had to find the present value of all the payments, which came out to be about $4,172 payment per month. And when we found the present value, we then were able to amortize it and figure out how much interest we paid on that, and then how much was going towards the principal, so that we could take the mortgage loan down on the balance sheet. So we had to have an extra bank loan for the first year of operations, and the extra bank loan came out to be $78,100. And we had to do that in order to make the balance sheet balance of the assets equal liabilities plus stockholders' equity. So our total liabilities was $1,058,296. So that's our liabilities. Now the stockholders' equity. So we had to we started off by issuing common stock to start the company, and that came out to $284,843, and we did that as a percentage of the sales so we could get our company going. And the retained earnings for the first year is just the net income for the first year, and then as we forecasted it down, we took the last year's retained earnings and added the net income of the current year. There was no dividends paid. Since this is a small, non-public company, there's no real stockholders in the company, so there's no dividends to be paid to anybody. So our total liabilities and stockholders' equity came out to be $1,424,217, and that ended up balancing the balance sheet. So that's the liabilities and the stockholder portion of Del Norte Golf Company, as we were able to come to terms with and find the information on the market and other information around the local area of the city.